Hello and welcome. My name is Sean Murphy. I lead the FinTech practice here at Norton Fulbright. In this session, we're going to talk about insolvencies in the crypto sector. Insolvencies in the sector have been making the news for most of this year, and there's been a crescendo of news coverage in the last few weeks. But this isn't a new phenomenon. In fact, we have seen insolvencies in the crypto sector for many years. And in this session, we're going to talk about what's been happening, what's caused it, and we're also going to look at some of the unusual issues that arise in the context of crypto insolvencies. And we may also touch on the process, the insolvency process, and ask how long it will take for all of the insolvencies to resolve themselves. I'm joined for this discussion by two of our leading crypto restructuring experts. We have Eric Daucher, a partner in our New York office and the head of our restructuring practice in New York, and by Lee Pascoe, who's a special counsel in our Australian restructuring practice. So we're in very good company for this discussion. So Lee, I'm going to start with you. I think of you as something of a historian of crypto insolvencies. Could you give us an overview of insolvencies that have occurred in the sector prior to this year, and maybe touch on what's caused those insolvencies?
Thanks, Sean. And yes, you're right. There's been a lot of insolvencies in the cryptocurrency space since 2014, in fact. So the first one being in Japan with Mt. Gox, where there were 745 creditors approximately. So none of this is really new. 2018 saw Europe being exposed to its first insolvency in the cryptocurrency space, and that was in Italy with the collapse of BitGrail. 2019, the Commonwealth countries actually came into the frame. Canada with Quadriga, which many people are aware of. That's the one where the director actually passed away and the assets were unavailable for distribution. Then we had Cryptopia in New Zealand. That answered a lot of the questions in relation to property and whether or not crypto assets belong to the creditors or they belong to the users. Then we look at the causes. Now, up until this point, there were generally security breaches, whether or not they were an internal or an external security breach or some form of fraud. They essentially involved the hacking of a digital wallet. What does that mean? That's essentially the place where the passwords to actually access the value in the cryptocurrency is stored. So you think of that like basically somewhere to store your PIN numbers. So what happens is the hackers actually get access to those digital wallets. They basically drain the funds, which means they steal the passwords. They get access to all of that material. There's then a run on the digital currency exchange, similar to a bank run. Or alternatively, the directors put up the white flag and simply say, we don't have enough assets to actually meet all of the creditors' requirements. So either way, generally ends up in some form of bankruptcy.
Great, thanks, Lee. So Eric, can you bring us up to date and talk about what's been happening this year and what's been causing the insolvencies this year?
Sure, thank you, Sean. Speaking of bringing the information on current crypto insolvencies up to date is almost a fool's errand at this point because it is changing minute by minute. I will do the best I can, nevertheless. This year's cryptocurrency enterprise insolvencies can really be traced, rather than to hacks by and large, to financial failure, which is the first large domino that fell was an enterprise called Three Arrows Capital. This was, in simple terms, a large cryptocurrency hedge fund. That fall was precipitated largely by a collapse of the Terra Luna system, which was supposed to be a stable coin gone very, very bad, as opposed to an asset-backed stable coin of some kind. Terra Luna was an algorithmic stable coin. It worked well until it didn't. When there was particularly trying times in the market, the algorithm broke down, value very quickly collapsed. It dragged Three Arrows Capital down with it. One of the things that came out of the Three Arrows Capital insolvency was a recognition of just how interconnected the large players in the cryptocurrency space really are. A number of prominent institutions had made loans, had asset deals with Three Arrows Capital, and you saw subsequent dominoes falling in fairly short order. So you saw Voyager Digital fail, you saw Celsius fail. There was then a little bit of breathing room, and there was perhaps hope that the wave of failures had ceased. That proved not to be the case. Most recently, we've had the failure of FTX, which was one of the larger cryptocurrency exchanges. The facts behind that are, again, not driven by a hack, but rather by financial instability, insufficient assets. A run on the bank, in simple terms, was triggered, and an entity that was supposedly fully backed in terms of deposits turned out not to be. Now, since that failure actually occurred, we're now back to the future here. There has been a hack on an enormous scale, it would appear, related to FTX, where the numbers vary, but apparently between 500 million and $1 billion worth of crypto assets were exfiltrated almost immediately following the Chapter 11 filings of FTX. I should mention that one FTX entity is also in liquidation proceedings in the Bahamas. That entity has sought recognition in the United States, and there is currently a fight underway as to the appropriate venue of those proceedings, as between the Chapter 11 case for most of the FTX enterprises and the Chapter 15 recognition case for FTX digital marketing. So very much watch this space. It's developing rapidly.
Thanks, Eric. So Lee, let's go back to you. You started to touch on some of the unusual issues that are coming up in crypto insolvencies. Could you sort of explore a little bit more what the unusual issues are in these insolvencies?
No problem, Sean. So basically, the nature of the assets and the nature of the creditors are very important, and they are anomalies in these types of insolvencies, generally because of the borderless nature of the businesses. So they're not located in one geographical area, notwithstanding that the companies are often registered in one place. So let's look at the nature of the creditors and their number. So depending on the holdings of the crypto assets and how they're characterized in a particular jurisdiction, you'll either have users of that exchange, so investors, being characterized as either unsecured creditors or beneficiaries of a trust. The number of those users is substantial. If you look at Mt. Gox, there were 745,000 creditors, approximately. Quadriga, 365,000. They were geographically spread across numerous countries. The other issue is the lack of traditional financiers, which Eric touches on. Basically, this means that your traditional banking secured creditor isn't actually in the picture. You have internal lending through other cryptocurrency businesses, which then sets off the domino effect, which we've seen in 2022. And then looking at the nature and location of the assets, generally they're crypto assets in these types of insolvencies, which is much different to a traditional corporate group collapsing where there's some form of tangible assets. There's nothing to actually sell here, or very little, a couple of chairs, a couple of computers, that actually has some sort of physical nature. The difficulty with that is crypto assets, they're volatile. Everybody knows that. So how do you value them? How do you know when to realize them? So timing, methodology. How do you know how to realize them? You don't want to flood the market with a particular type of crypto asset because you can actually devalue the asset. Again, they're not all located in one jurisdiction, so identifying them, getting them in as an insolvency professional has to, is also very difficult. And you'll often be faced with cross-border issues and cross-border applications. So they are very complex types of insolvencies.
So Eric, these businesses often have, as Lee's mentioned, thousands or tens of thousands or possibly even hundreds of thousands of customers across the world. What does insolvency mean for those customers?
Nothing good, but beyond that, it is a case-by-case analysis. One of the things you discover in this currently lightly regulated space is that the terms and conditions of what it means to be a depositor at these institutions vary wildly among the different platforms. Some of them will say quite forthrightly in their terms of service that any assets deposited become assets of the crypto platform. You may be getting an interest rate in exchange for that deposit, but effectively you've established a debtor-creditor relationship. People may not realize that when they're depositing assets, but that's what the terms of service say. Others, and we'll use FTX as an example here, say very clearly that assets, customer assets placed with the exchange remain property of the customer and title remains with the customer. Couldn't be more different. Now, in practice, does it mean that the platforms necessarily treated those assets differently and that one will be more recoverable than the other? Time will tell, but there are stark differences in the legal underpinnings for customer rights.
And just one last question for you, Eric. How long will these insolvency processes take to play out?
It depends. And the reason I am cautious to put a date on it is there's going to be a high degree of investigation in some of these crypto platform failures. We've already seen in Celsius, for example, an examiner was appointed. This is a third-party neutral, effectively tasked with performing certain analysis. We may very well see an examiner appointed in FTX as well, although their quick transition to third-party management may limit the court's appetite for appointment of an examiner, but we'll see. It's going to be an extensive exercise to trace assets and recover assets. And so even if there were to be a relatively quick bridge to a plan of reorganization or a plan of liquidation, one would expect that the asset recovery process is actually going to drag on for a very substantial period of time.
Great. Well, thank you both very much for your insights. There are lots and lots of other questions that I could have asked you. And as Eric has mentioned, this is a rapidly evolving situation. So I suspect that we'll be recording another one of these videos before long. In the meantime, if anyone who's watching this has any questions, please feel free to reach out to any one of the speakers today. Or alternatively, you could contact your normal contact at Norton Rose Fulbright. All of our details are on our website. But for the moment, thank you and goodbye.